Good morning, everybody. This is the live market open for Tuesday, February 16th. I'm Yohay Elam, Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. So we have the ongoing cheerful mood in markets. We'll talk about that. We'll talk about various charts and levels. The next 24 hours, which are expected to be quite busy. And of course, your questions. Please post the questions in the chat box. If you cannot see the chat box alongside the video, here's the address for the chat on the screen, tlk.io/fxstreet-forex-live-video. So let's start with the market mood, because we know that the mood moves things more than actual indicators in the past 2 months or so. Yeah, I'm good. Bon dia. Everything's nice here. Good to see you all. Well, the big event for yesterday, and it still has impact today, was Draghi's testimony. He spoke for around 3 hours. I followed that most of the time. He managed to drag the euro down. He managed to drag the euro down because the euro was already trending lower, and he hit it when it was going down. So he took advantage of that. What did he say in general? Draghi said he's ready to act in March, that the situation has deteriorated. He blamed the slowdown in emerging markets, things that we generally know, but the market was more vulnerable to his words. What I found interesting in his speech, let's take a look at the euro chart while I'm talking about that, is that what I found interesting in his speech that he basically he asked the governments to do more in a manner that we haven't heard before. So in general, he always says, listen, we're doing our part and everybody needs to do their part. But this time his words were much stronger. He said that basically in the past 4 years, they were the only game in town, okay? He didn't use these words. He said we're the only body that has stimulative action, okay? Basically, and he also said that governments who have more fiscal space should do more. Germany, okay? Now, he didn't say things too directly, but he did say that there is need for more fiscal activity, for more spending, also for reform, of course, for the Eurozone economy to move forward. And the ECB is doing everything that it can, but it cannot do things only on its own. Okay, so that was quite a strong message. He repeated it quite a few times. So I found that sort of relatively strong criticism. In general, he is ready to do more in March. He tried to soothe, also talks about bank issues. He denied rumors that the ECB is going to buy bad Italian loans, non-performing loans, just changes to collateral. Anyway, it was quite interesting. We had euro-dollar fall. Let's show you the chart again. From, well, it was already deteriorating under 112. It fell all the way to 111.28. Since then, it has recovered just a bit, but all in all, it remains depressed. We're about 20 pips above the lows seen yesterday due to Draghi, still not moving anywhere fast. Okay. Yeah. So here we are with fall in the euro. This also helped the mood in general. Okay, so when we have one central bank, an important central bank like the ECB, pledging to do more in a very strong manner, well, we had a continuation of the positive market mood, not only continuation of the slide of euro-dollar, of the safe haven euro, but also the yen enjoyed this. So the yen continued rising, went above this line here of 114.30, under 115 still. 115.25 is the next resistance, followed by, of course, 116, which was the line in the sand for the Bank of Japan. Anyway, it's a sigh of relief for the Japanese, because dollar yen fell so much, and now we're at least about 350 pips above the lows. Okay, so it's also good news for Japan, this continuation of the positive squeeze. Okay, let's talk about, well, let's continue with other currencies and then talk about more events. Pound dollar, yesterday we had Ian McCafferty, who is a hawk at the Bank of England. He voted about 5 times to raise rates from 0.5% to 0.75. Okay, he changed his vote last time, and yesterday he talked that the case for raising rates is less compelling. Okay, so that hit the pound because he's known as a hawk. We already knew that he became more dovish, but hearing it from the mouth of the horses, they say, hearing such sort of direct words, this hit the pound, pushed it sort of below 144.50, okay, which is sort of a pivotal line, pushed it to the lower end of the range. For 143.65 is support, followed by 142.30. Maybe we can add a line right here as resistance, 145.80. Okay, so all in all, we're on lower ground in the pound because of these words, but the better mood, remember, helps the pound, so we're not doing that terrible because the general mood is risk on, weaker euro, weaker yen, better all the rest. To see the commodity currencies in their best, it's the Canadian dollar. Dollar CAD broke below this line of 137.87. I mentioned it a few times because it worked in both ways. It worked as resistance, it worked as support, yesterday, and it fell. Okay, this is a better mood, of course. We're around 90 pips down, but also the improvement, this rise in the price of oil, the recovery continued. Remember, just last week we touched $26, almost 26. Now we're at 31.25. In terms of percentages, this is nearly 20% off the lows. Okay, so that's quite a lot. This morning specifically, nearly 5% on WTI, above 5% on Brent, above, right, if I remember correctly, $35 a barrel. Better mood in markets, Draghi, but also there is more talk that today there will be a meeting in Doha, the capital of Qatar, between officials from Saudi Arabia and Russia to discuss a cut. Okay, so if this kind of thing materializes, it's big news. Both countries are under pressure, but it'll, of course, serve countries. If they do cut production, it'll serve countries that continue producing, such as other OPEC members, Venezuela, smaller countries in the Gulf, Norway, Canada, and of course the US shale industry, which the Saudis planned to sort of reduce the output there. So it's a very complicated game. Anyway, currently higher oil prices, higher Canadian dollar. The Australian dollar, also risk currency, also moving higher, 71.40, battling, rose above this line, still keeping a distance from 72.20, but the trend is more or less higher. We also had news from China today. It wasn't supposed to be important news. It was new loans, but they surged so much that it already had an impact, positive impact on the Australian dollar, as this was good news from China. Okay, I don't know if new loans eventually will just be new debt or something like that, but let's just look at the numbers. Money supply jumped more than expected in China to 14% year over year, and new loans, look at this big gap. They were expected to stand on 1.8 billion, and the actual was 2.5 billion. So that's a beat worth 35% or something like that. A huge surprise. Yeah, so well above expectations. Was supposed to be a third tier figure, but when it jumps so much, it's of course huge news. Okay, the single currency that stands out, sort of ruins the party, is the Kiwi. But here we have three reasons why the Kiwi, look, it's just down on the day against the positive mood in markets, but it didn't fall below support at 65.80. Okay, we have support 65.80, resistance 67, 67.40. Why did it fall? Three reasons. Okay, first of all, retail sales came out worse than expected. It's a quarterly release in New Zealand. Here it is right here. Okay, the retail sales, the headline figure, which is more important than the core one, rose only 1.2%, worse than expected. Expectations were for 1.4, and the previous figure was revised down from 1.6 to 1.5. Second thing, inflation expectations in New Zealand, they fell to the lowest level since 1994. Okay, that's 22 years. All right, and to 1.6, getting far from the 2% target. It was 1.9 last time, 1.6 this time for Q4. Bad news for for New Zealand. And the third thing was a surprising comment by the Prime Minister of New Zealand, John Key, said that he was surprised to see the kiwi relatively strong in comparison to the fall in milk prices. Basically, that's a comment saying we want a lower kiwi. So these three things, retail sales, inflation expectations, and the comment from the Prime Minister, all weighed on the kiwi and made it send it to a different direction in comparison to its peers, the Aussie and the Canadian dollar, which had their own reasons to rise. Okay. Comment here from Sinatra. Squeeze out like Spanish orange. Thanks. Yeah. I see some hidden bearish divergence on Aussie dollar daily. Let's look at the daily chart. Anyway, guys, you can of course share your charts, put a link to some image, and don't share it with everybody else. Yeah, I would say it's quite choppy. General trend is still, well, it's a bit of a mess, but it's still to the downside. We still see in the long term lower lows and lower highs. So this point's lower. We've seen some kind of correction since the beginning of the year, but it hasn't gone too far. Currently, in the past 3 days, since Friday in the European morning, Monday, and today, we've seen better than expected, sort of a much better market mood. Began because of other things, but now it's Draghi was the latest, gives the latest boost. Anyway, but yeah, we're not seeing the Aussie dollar going anywhere fast, okay? Let's continue with other currencies. Dollar Swiss, remember, intervention by the Swiss National Bank, remains under parity, but it is moving higher thanks to the strength of the US dollar against the euro. Okay, remember, Swiss franc trades much more against the euro. Currently finding this narrow range here between 98.50 and 99. Euro Swiss holding its ground above 110. I suspect there's intervention to keep it above 110 by the Swiss National Bank. We had it rise from the bottom all the way to 112. Now it's in these levels. Euro pound, the fall of Draghi had its effect, okay? This is a strong line, 77.40, because it worked in the past as very, very strong support here. We had the pair rise above this level last week, I think, or the week before. Anyway, we went all the way, almost touched 79. Now we're back down. This is the Draghi effect. Okay, pushing it down. Further support 76.60 and 75. Okay. Euro yen also sort of, well, these two currencies have weakened, both the euro and the yen against the US dollar, and they haven't been moving in very different directions one against the other. This is the big surge here because of the Bank of Japan going negative. It was just 2.5 weeks ago. The strengthening of the yen pushed it back down. Stronger euro, but now we're seeing it sort of finding its range. Pound yen, one of the more exciting currency pairs, fell to 160 with the bad mood. With the better mood in markets, it's moving back up. But remember the comment yesterday by Ian McCafferty sort of kept the lid, kept this glass ceiling, if you wish, 166 on pound yen. Okay, so today we have events in the UK. We'll talk about them very soon. Let's see if I didn't miss anything regarding yesterday's event. Talked about Draghi quite a bit, his appearance in the European Parliament. Oil prices advancing, the potential Russian-Saudi meeting today. And US markets are coming back. Yesterday there was a small holiday in the United States, a bank holiday, President's Day. Bond and stock markets were closed, not a major one, but somewhat lower liquidity. And today, maybe US traders will do some catch-up, okay? But remember, it's not such a big holiday. Okay, other data points we had yesterday. Eurozone trade balance, nothing excited. Chinese new loans jump. Everything about New Zealand, the negative stuff, we talked about that. We had also the meeting minutes from the recent RBA meeting. They remained neutral, just like the statement, not a game changer, okay? What do we have today on the agenda? Okay, just after the show, well, more than half an hour after the show, we have the UK inflation data. Okay, this is key for the next meeting by the Bank of England, by the Monetary Policy Committee early in March. All right, so we have lots of figures. Let's start with the most important one. That's the consumer price index, the headline figure, year over year. Okay, we're expecting it to rise just a bit. Why? You might say oil prices are falling. We should have headline figure and inflation falling as well. But it's year over year, and this time last year in January, we had a much bigger fall. Okay, in absolute terms. So we had a fall from fall to around $40 from much higher levels beforehand, around 100 in the previous year. So yes, oil prices are lower than last year, but not when looking year over year, it's not that bad. Anyway, we're expecting the headline figure to continue ticking up from 0.2 to 0.3. Okay, any miss on that, any disappointment, of course, will hit the pound, any beat will be positive. That's the most important figure because that's the mandate of the Bank of England. It's supposed to keep inflation around 2%, or more precisely, in a band between 1 to 3%. Okay. Second in line, if you blame only oil prices for the fall, even though if you don't buy my explanation about the base effect of last year, second thing to watch is the core figure. Okay. Also, year over year here is more important. Here, expectations are relatively low. Okay, it's expected to drop from 1.4 to 1.3. Still healthy, under the target, but not too shabby. Okay, that's the third in line. The second. What else do we have? Of course, the month-over-month figure will be watched. It's expected to fall, yes, because of oil prices, 0.7%. The month-over-month for core, well, I don't have that. We also have retail price index. I would say that's the third one. The year-over-year one is more important. It's expected to rise 1.2 to 1.4 because this is sort of a better measure of prices at shops, at retail outlets. Okay, month over month. We also have the producer price index. We have a differentiation between the input and the output. I wouldn't say that that's important. I would say that you should look at the PPI only if all the other figures come exactly as expected, and if we have some wild surprise in the PPI, that would be of importance. Okay. What else do we have here? Yeah, and the home price index, it's the government one, it's a bit lagging. Shouldn't be of importance. So once again, most important thing, headline CPI in the UK, then core CPI, and then retail CPI. Okay, CPI, consumer price index. So retail price index, it's RPI actually. Anyway, inflation remains low in the UK, like in many other countries. For the pound, it's always a market mover. We're currently seeing the pound gain some ground, but limited and waiting the event. Remember, when we have events in the UK, we tend to see in the 15-20 minutes before the release some kind of movement. Sometimes it's a leak. Sometimes the market just expects something. There are false rumors. They're expecting a higher result or a lower one. If we're seeing pound dollar or the pound in general move up, there is some kind of expectations based on real stuff or not that the figure will be positive. That means that when the figure comes out and it's only okay or just a bit positive, we can have a buy the rumor, sell the fact. It's very, very common in the pound. Okay. And the same thing for the other way. If we have a pound dollar sliding in the few minutes before the release, and then the figure comes out at a small miss or nothing, or as expected, or even better than expected, then we could have a very, very big bounce. Okay, so it's all relative. At the moment, we're already seeing the pound on the move, continuing quite a nice rise during the show, 144.68. Almost 30 pips. Let's see if it's... No, I think it's an isolated case. Yeah, other currencies in the past 20 minutes have not moved too much. So yeah, pound is jumping. Perhaps I'll try to find and see if there's some kind of headline, but usually it's the market just front running the no, nothing that I can see, but the market is front running the event. Okay, so the expectations are for a better than expected figure. If this prevails until the publication at 9:30 GMT and a little bit more than an hour from now, this trend, then the scenarios are like this. If we have a beat, a small beat, or as expected, or below expectations, we could have the pair fall all the way down and even lower. If we have a very, very big beat, much better than expectations, then we can see the pair extend its move. But a better than expected figure, assuming this trend prevails, seems to be priced in. Okay. Well, currently we're stuck at 144.66. Let's see how things develop. The move in the sort of last half hour, last 15 minutes before the release is more important than what we see now. Okay, so that's 9:30 GMT. At 10 GMT, we have German ZU economic sentiment. ZU, which is the Zentrum for, it must be something hard to pronounce in German, but oh my God, that's a long thing. Zentrum für Europäische Wirtschaft. Wow, that's a long word. Anyway, the ZU figure is expected to, well, that's actually not the important one. The most important one is the economic sentiment, okay? We had it all in all positive during 2015. We had it then slip and then recover once again towards the end of the year. You can see here on the chart. The trends situation, of course, was much worse in 2011 and 2012. And this time, with the deterioration in global conditions, okay, it was 10.2 last time. It's expected to fall to 0. All right. You do well with your German. Don't be so humble. Yeah, well, that's a hard word. It has lots of letters. Anyway, this time we're expecting, because of the deterioration in sentiment, about China, about oil prices, everything we all talk about, we expect the sentiment to fall in Germany, okay? According to this figure. It's the second most important release. IFO is the most important one, but ZU is released earlier. These are figures for February. It's a fresh survey. So ZU also has an impact, okay? If we fall to negative, a negative number means pessimism about the German economy, about the European economy, about the global economy, then it could have more negative effect, okay? In this case, what does this mean? I think the reaction could be straightforward with the euro, okay? It means a better figure would be a stronger euro, and the worst figure could be a weaker euro. Now, why am I saying this makes sense, right? But I'm saying it like it's very surprising, because usually we had these risk on, risk off sentiment. This time, I believe that that markets are focusing on, have regained faith in central banks. And if the sentiment is really bad, that means more money printing from, or higher chance of doing stuff from the ECB, European Central Bank. That means that if we have a negative figure, it could weigh on the euro. If we have a positive figure, it lowers the chances of action from the central bank, and that could boost the euro, okay? In many other cases, bad news is good news for the euro, and the other way around. I think that today we'll have a straightforward reaction, okay? Remember, the second most important survey, but the fact that it's released earlier has an impact, okay? And the survey was made before the last 3 trading days, if I'm not mistaken, before the mood improved. And people surveyed there are moved by the mood. Okay, what other events do we have today? Second tier or third tier US figure today, US Empire State Index. It's a manufacturing survey for the region, the Fed region of New York. It's not only the state of New York, but other areas as well. It has been negative, like many other manufacturing figures. Many people are talking about a recession in the manufacturing sector in the United States. We've seen it negative for quite a while since the summer. Last time it deteriorated all the way to minus 19.37. Remember, this reflects contraction. It's a regional one. It's not a nationwide one, but anyway, it's expected to improve from minus 19.37 to minus 10. Remember, the manufacturing sector isn't doing well, not in the US, not in the UK, not in the Eurozone. So it will not be surprising to see a bad number. For those of you trading the Kiwi, we have more stuff coming from New Zealand. It's a busy week in New Zealand. We have milk prices coming out at in the afternoon. I don't have an exact time, but it's usually around 3, 4, 5 GMT. In the last 3 auctions, the price of milk, the price of dairy products fell. It was negative in the 1, 2, 3. Last time it was a drop of 7.4. In general, we had a few positive weeks. It's released every 2 weeks, and but it isn't that it might bounce now after 3 negative auctions, but who knows? It's always a wild card, and it always impacts the Kiwi. Another thing perhaps to note, quite late at night, I mean here for us in Europe, at 9:30 GMT, we have the API weekly crude oil stock. It's sort of a precursor for the crude oil inventories, which is released this time on Thursday instead of Wednesday. I don't have predictions here. It's sort of for those trading oil, this could be meaningful, but markets still put most of their attention on the crude oil inventories. At night, we have for Australia the Westpac leading index, not so important. What is important, perhaps, is a speech by Rosengren, the Federal Reserve. He's the president of the Boston Fed, and he'll be speaking at around midnight GMT. Okay, I have here midnight. Anyway, these are the things that are going on. Tomorrow, we already have impact from an event that is coming tomorrow. It's the Fed's meeting minutes. Let's talk a bit about that. I see I have a bit of time. So the meeting minutes are from the Fed's decision on January 27th. They're a bit old. They came before the latest jobs report, which was generally positive, but before the recent market turmoil, which was, of course, negative, before Yelen's testimony. So in general, they should be ignored, right? Because we had so many developments since then, including a speech by Yelen, a 2-day testimony, all right? So, but that's not exactly how we should look at it. Why? Because the Fed, it's not sort of a raw description, a raw recording of what happened on that meeting. It's a document of what happened. Someone makes this document, summarizes the words, and this document is revised and revised again, including right now, okay, including this week. So the Fed is, of course, very, very aware, fully aware that the markets are looking at this figure, at this document, and it makes sure that there is a message sent out there, okay? So what we're looking to see there is if they still are talking about the rate hikes this year, because it's totally priced out by markets. I'll show it to you soon. How they see inflation. They've been worried a lot about inflation. How they see employment. If perhaps they had the employment figures before their eyes. I don't think so, but if they were optimistic about wages or not. And how worried, of course, they are about global developments, because everybody likes to blame China. And let's see, and we heard that from Yellen, let's see if they repeat it once again. Another thing, Yellen said it's not our fault what happens in markets. Let's see if it's reflected in the meeting minutes. I suspect that the meeting minutes will be slightly more hawkish than markets currently expect, and that could perhaps ruin the mood in markets. Okay, so we had 3 days so far, at least 2.5 European sessions so far, of a positive market mood. This mood could change anytime. If it remains positive, I suspect, I'm not sure, of course, we'll talk about this tomorrow again, that the meeting minutes could show a slightly more hawkish Fed, perhaps optimistic, which is a good thing, but perhaps also sort of keen on raising rates in relative terms to the dovish Fed, and that could perhaps be less positive for markets. That could, if it's less positive, it means stronger euro, stronger yen, weaker commodity currencies. I'm not sure. It's just my hunch, of course, but yeah, that's how I see things at the moment. So this is sort of the main event for the week. So markets are looking at that as well. Okay. Any questions? Let's talk about other events this week. Yeah, okay. So let's sum up what we had so far. We're still at the beginning of the week. We have more ahead of us than before us. Just to remind you that yesterday, talking about this positive market mood, but what we had yesterday is actually bad news from both Japan and China. But perhaps bad news is good news. What do I mean? We had in Japan GDP contracting. The output in the world's third largest economy fell in Q4 by 0.4%. That's not good news, okay? But that raises expectations from the Bank of Japan to act. So, and that's good news, of course, for markets, and bad news for the yen. No more safe haven because we're going to have more BOJ action. Same thing with Chinese trade balance. It showed a big fall in imports, a big fall in exports, which is bad news, less trade in the global economy. This was, of course, slightly blamed on the new year. That was a bit, the data was sort of skewed, but it doesn't matter. It's bad news. But again, this might imply more stimulus from China as well, maybe a rate cut or something like that. Today, we have UK inflation figures, as I mentioned, German zooeconomic sentiment, and tomorrow, even before the minutes, we have other important figures: the UK jobs report with wages in focus, the housing and PPI figures from the US. They could go in mixed directions and not necessarily be very meaningful, but if they both go in the same direction, all these figures, housing starts, building permits, producer price index, then we can have a nice reaction. And the Fed meeting minutes. On Thursday, we have the Australian jobs report, very important, of course, for those trading the Aussie, and oil inventories pushed back to Thursday because of the US bank holiday. And on Friday, we have the UK retail sales and the US CPI, sort of the grand finale of the week, because the Fed focuses more on inflation. All right. Any questions? Perhaps we'll talk about more charts. Let's look at what's going on at the moment in markets. Oh, I promised to show you this thing. Let's refresh it. That's the implied probability of a rate hike by the Fed. Okay, March 16, 2016, it's the upcoming meeting, exactly in 1 month's time. Zero, absolutely zero, very round number. That will have a rate hike. We already had a small rise to 5% chance of rate hike, and we're back down to zero, okay? Nobody expects the Fed to hike in March after the recent turmoil. Looking, oh, here we are, looking at April. Most chances no change, but there's a small chance we'll even have a cut, okay? According to the implied probability by bond markets. Here, okay, very low chance of any hike in June, July, September, November, December, and all the way up to February 2017, a year from now. Most chances are that the rate, interest rate in the United States will stay unchanged. Okay, according to bond markets. Of course, these are expectations and they can change. They do change all the time, okay? Question here, what's your thought about ECB acting in March? Do you think it's more possible than not? Yes, the answer is yes. It's 100% certain that the ECB will act in March. They said it many times. Draghi repeated it yesterday. And perhaps even more importantly than Draghi just repeating what he already said, he has backing from the Germans. He has backing from Jens Weidmann, the head of the Bundesbank. Okay? Even Weidmann, that opposes QE, doesn't like this monetary financing, which is what it is. He doesn't, he thinks the ECB has done too much and governments need to do more. Even he, in light of the falling inflation and global worries, perhaps of problems in German banks, perhaps many other things, he also expressed his support for reconsidering monetary policy in March. And this shows a consensus for action. I think the big question is, what are markets expecting? And I don't know what it is. It's a bit too early. And how will Draghi meet those expectations? The ECB doesn't have too many tools left. Okay, they already set the historic negative deposit rate back in June 2014. He already lowered it twice, first to minus 0.20, then to minus 0.30, and back in December. The QE program has been extended to March 2017, and the ECB pledged to reinvest proceeds. And what else can they do? So, in general, these are the main two tools: negative interest rates, the deposit rate, and QE. They can enlarge the monthly buys of QE from 60 billion to 80 billion, for example, or 70 billion. And they can enlarge the things that they buy, perhaps shares as well, other kinds of financial instruments. Their hope was that they will buy asset-backed securities, ABS, and that this would trigger creation of more ABS. That means more loans, more asset-backed securities. Okay, the ECB would not only push the yields lower, but also enlarge the market for this. Don't think this really happened. Okay. And regarding the negative deposit rate, they can always lower it to lower ground. Of course, we have examples from Denmark, Switzerland, and Sweden. So last time, some had expected Draghi to cut the rate all the way to minus 0.40, minus 0.50. These can happen. Minus 0.70 has also been a rumor. I don't think markets are expecting that. But we'll have to hear. Maybe he has another bunny in his sleeve. I don't know, but they'll have to do something really big because last time in October he created big expectations, promised to act, repeated that the expectations were too far. They did do a lot in December, but it wasn't as markets had expected. No new QE especially, and what we had is a 460 pip rally in euro dollar. I'm sure Draghi was frustrated. Why am I sure? Not only because of the rise in euro dollar, but because in the following day he admitted that he was disappointed, and he tried to convince markets that what he did was actually big. So it'll be, I guess he'll try to lower expectations a bit more towards March and then over-deliver, because usually in the past he under-promised and over-delivered. In the end of last year, it seemed like over-promising and under-delivering, so he'll have to improve on that. I think he's able to do that. Anyway, at the moment we're already seeing euro dollar, thanks to Draghi and thanks to the better mood, 200 pips below the high seen last week of around 113.75, which is important resistance. Okay. Okay, let's get to the wrap up for today. Take a sip of water. This is the wrap up for the live market open for Tuesday, February 16th. We still have a better mood in markets. Draghi joined in with his significant contribution. He dragged the euro down. He pledged to act. He said, we never give up, we never abandon, continue fighting on. He also had a lot of criticism towards governments. He said basically that the ECB is the only game in town. In other words, his words were that it's the only institution that has a stimulative program, and he called for governments with more fiscal space to do more. Okay, he tried to be diplomatic, but he had his word. Okay, oil prices continue advancing with the better mood in markets and the potential Russian-Saudi meeting today in Doha, Qatar. US markets are coming back after bank holiday yesterday, so we could have liquidity higher. What else did we have yesterday? Worth mentioning, Chinese new loans jumped a lot. It was supposed to be a second, third tier figure, but it was so good. I mean, such a big jump that it helped the Australian dollar. In New Zealand, we had 3 negative events. We had weak retail sales figures, the lowest inflation expectations since 1994, and the Prime Minister, the head of state in New Zealand, talking down the Kiwi, he had expected the Kiwi to be weaker given the fall in milk prices. Okay, and the RBA meeting minutes were neutral. Okay, so before we move to the events of the day, let's look at charts. Euro dollar is a bit higher within the range, but in general, it's 200 pips below the highs. 110.70 is support, 112.50 is weak resistance, followed by 113.75. Pound dollar awaiting inflation data, moving to the upside. So we're seeing a bit of USD weakness, but it's more here the strength of the pound. Perhaps markets are front running a better than expected figure in UK CPI. Remember, with UK CPI, first foremost headline inflation year over year, second core inflation, third retail price index. Okay, these are the events to watch. 145.80 is resistance, followed by 146.50, support 143.65. Dollar yen, well, we're seeing some sell-off of the US dollar, minor sell-off, currently holding above 114, struggling with 115. 115.25 is resistance, 114.25 I would say is support. All in all, better mood, better dollar yen, weaker yen. Dollar CAD continues its downfall, falls even more on these hopes about oil. Oil prices are rising in general, so this is good for the Canadian dollar. Some support here at 137.20. It broke below support at 137.87, which now turns into resistance. Further support 136.20. Aussie dollar moving high, but doesn't look so strong. 71.40, some kind of support. Strong resistance 72.20. And the Kiwi dollar managed, well, it did suffer from these 3 events, but it did find support here at 65.80, resistance 67 and 67.40. Okay, events for today, as I mentioned, UK inflation data, CPI, core CPI, and RPI. If the CPI comes out as expected, then core CPI will take center stage. At 10 GMT, the German zoo economic sentiment expectations are that it'll fall to zero. Balance between optimism and pessimism. If it goes negative, it could have a significant impact. US Empire State Index expectations are low. Milk auction in New Zealand in the afternoon and a speech by Rosengren are the next events. The focus is on the next hour and a half or so with the inflation data in the UK and the German zoo economic sentiment. Okay, and then we'll have a focus in the US more tomorrow with a few figures in the afternoon, and then the FOMC meeting minutes. Okay, before we head off, I see more questions here. How do you see Aussie yen, Euro Aussie, Euro CAD, and Pound yen? Well, we talked about Pound yen at the beginning. Better mood supports stronger Pound yen. Levels to watch here, 166. Maybe this will be broken now. I mean, significantly. The next line is 167, followed by 168.50. Support at 163.80, and 160 is low support. In general, the market mood is better, and this supports a stronger Pound yen. Aussie, well, let's see which currencies I find here. You asked about, let's jump to Euro CAD. Falling because the euro is a safe haven, the Canadian dollar is a risk currency. We had it battle this line very, very nicely right here. 180, 157, sorry. Just under 159. Anyway, we fell all the way down. Currently 153.30 and 153.25. I would say some kind of support. Sorry, 152.40 and 151.50 are support lines. Some kind of weak resistance here at 154.35. Okay. All in all, euro safe haven, CAD risk currency, stronger oil prices, druggy drag, clear trend to the downside. 152.40, 151.50 are lines to watch. Euro, Aussie, and Aussie yen. Euro, Aussie, 155.66. 158 is resistance. Also here, not such a strong trend perhaps, but Euro CAD is much more interesting because the Australian dollar isn't breaking so much ground. Anyway, support is at 153.30 and 152.50. Okay, resistance at 158. And last but not least, Aussie yen. Sure, I had it here. Yeah. Same trend. Yen is a safe haven. Aussie is a risk currency. 82.10 at the moment. 83.50 is resistance. Some kind of support at 79.70. I would add perhaps this line. 77.45 as support. Strong resistance at 86.50. Okay, I hope this answers your questions a bit fast. Anyway, we have a clear trend of risk on, better market mood. Okay, it means in general. Oh, now we're seeing during the show some kind of general weakness in the US dollar, also against safe havens. But it's this weakness of the US dollar is much more pronounced in the pound, in the loonie, even the Aussie and the Kiwi, which are a bit trailing behind. Okay. Then in the euro and the yen, the euro is still below the pre-druggy levels. Okay. The pledge to do more by central banks certainly helps. All right. So that's it for today. Thank you very much, everybody, for coming, for all your questions. I'm very glad we have questions. We're going to be here, of course, tomorrow as usual. Wish everybody a safe, successful trading day, and see you tomorrow. Bye-bye.